get started. Welcome to Genwest Capital webinar by Edgar Darrell. My name is Irene Cho and I'm your host. Today's topic covered buying real estate with SBA, California State Guarantee, and USDA BNI loans. This webinar is brought to you in partnership with EWDD and BusinessSource Pico-Union Westlake region operated by PACE Business Development Center and Genwest Capital. This webinar will be recorded and you may find it on our website e-library after a week. Just a little housekeeping before we get started. Please mute yourself during the webinar. We will have a last 5 to 10 minutes for Q&A session. So please ask the question during Q&A session using raising hand emoji or writing questions in the Q&A box or chat box. Okay, before we get started the day, I'd like to introduce PACE briefly. PACE was founded in 1975. We are a 501 nonprofit organization. Our PACE Business Development Center provides many counseling services for local small business owners. We also have various loan programs you can apply to your business. So if you have any questions, please feel free to visit our website or give us a call. Let's welcome our guest speaker, Edgar Darrell. Okay, Edgar.
Right. Thank you, Irene. Hello, everyone. My name is Edgar Darrell, and I'm your financial sidekick today. And as a commercial loan advisor at Genwest Capital, I've spent over 25 years helping businesses like yours secure funds for business capital needs. And, I spent some of those years working for banks like Citibank, Wells Fargo, and Union Bank. So you can say that I've learned a trick or two about business financing. On a lighter note, I was also a past member of the Hair Club of America until my membership was revoked. My focus is on SBA financing, commercial real estate loans, and working capital solutions. So think of me as a financial Swiss Army knife. Whatever you need, I've got it covered. So let's see here. Buying real estate is an opportunity for everyone. It seems like the last couple of years, it seems like a distant dream. But buying property ownership is it's not just a dream, it's a strategic advantage. With the right financing tools like SBA, California state guarantees, and surprisingly, USDA and BNI loans, it's more achievable than ever. Today, I'll show you how to turn these powerful programs into actual real estate opportunities. So, towards this seminar, I will give you some real-life examples of what that entails, okay? So let's begin. So the purpose of this webinar is to provide you with an overview of the different kinds of programs, government programs, state guarantee programs that are available to you. And I'll show you the importance of using government-backed loan programs. My focus today is on SBA 504, 7A, and California State Guarantee, as well as USDA BNI loan programs. By the way, USDA and BNI stands for Business and Industrial. So USDA is a program where certain parts of the region are eligible for that. And later on, I'll show you if some of the areas in Southern California are eligible. You'll be surprised. Now, the first program I want to talk to you about is the SBA 504 loan program. This is a well-known program that is sought after by prospective real estate owners because it allows you to put a minimum down payment, usually around 10%, and then the rest will be provided by the SBA or the CDC. So it's in essence, the SBA 504 loan program is a long-term fixed rate financing program for owner user commercial real estate properties. Usually the loan structure is what they call the 50-40-10, where the 50% of the funds will come from a bank, financial institution, or credit union, or any real estate lenders. 10% would come from the borrower, and then the remaining 40% would come from a CDC, which stands for Certified Development Corporation. So these CDCs, what their primary job is to issue a debenture to finance the 40%. So they will carry on the risk of the 40% financing. In typical cases, as you know, when you buy commercial real estate on a conventional basis, the down payment requirement is right around 25% for owner user properties, 25 to 30%. For non-owner or investment properties, they can go as high as 35, 40, 45% down payment. Now, with the 504 program, it allows you to get the right property to occupy with only limited leverage from your part. So it's only 10%. The maximum loan size for this is around 5.5 on the SBA loan side or the CDC portion. And the maximum for the first trust deed is, excuse me, on the upper $10 million range. So this type of program is well known to finance gas stations. If you're in the business of, a gas station or trying to buy a hotel, motel, this is a good program for you because the loan amount, especially here in Southern California, where the rates or the loan amounts are extremely higher, the 504 fits right perfectly. Now, you can use this on top of the real estate portion. You can also use this as a construction loan. So for instance, if you have a piece of land that you own or you want to expand on a land that you want to purchase next door, you can do so with this type of program. So you can construct, you can purchase, you can improve your existing property. So if you have an existing property that you got from a hard money lender, chances are you can also refinance this to lower your rate. So when you get your loan approved, your loan closed, you will have two loans attached to your property. One is your first trust deed, which is issued by the bank. And then you will have a second, which is the SBA CDC. So think of it as a first and a second mortgage on your home. So you have a first mortgage on your home, and then you have a home equity, so to speak, on your second mortgage. So that's similar as far as the structure goes. So you have a first and a second. The first trust deed has a lower market rate and also the second trustee. So right now, without getting into details, the rates for the 504 program is the first trustee portion is right around 6 to 7%. And then the second trustee is right around 6.8, I believe. And the structure is you can have up to 25 years of amortization on your first or second, or you can have a 15 on the first and then 25 on the second. So it's a combination depending on the underwriting criteria. Like I said, the maximum loan size is around 5.5 on the second trust deed. And then the first trust deed, there it's really unlimited. It depends on the transaction amount. So a specific example would be a hotel motel that's being acquired, with a $10 million purchase amount. So, according to the structure, 50% of that would come from the bank. So 10 million, 5 million of that would be financed by the bank. And then the 40% will be financed by the CDC or the SBA. And then the 10% would be coming from your equity. So typically that would be a good structure for hotels, motels, gas station, any larger purchase of real estate properties. This is your go-to program. Like I said, the benefits is low interest rates comparable to other programs, conventional, also low down payment as low as 10% down. So a specific example for this would be a manufacturing company in San Diego who, wants to purchase a warehouse. They don't really have funds. They have, enough funds, but as you know, San Diego is a high rent district area. So their funds are limited, if they were to purchase another property out of area. So if they only have $300,000 on a purchase of $3 million, this program is perfect for them because it allows them to purchase, own a piece of real estate for their business, with the many tax benefits, write off interest, leverage your assets, and you can be in this property for as little as 10% down with financing up to about 45 to 90 days. So that's a typical timeline when you purchase through SBA loan program. Now, second program that I want to discuss with you is the SBA 7A loan program. It's also part of the Small Business Administration. This is their flagship program. This is a flexible program where you can combine real estate and working capital. This program, unfortunately, has a cap of $5 million right now. The down payment is similar to the 504, 10% or 15%. The terms are similar, up to 25 years. Now, the difference being with this SBA 7A loan program is that there are many uses for this. You can buy a real estate, you can improve a real estate, you can buy a real estate plus equipment. You can also apply for working capital on top of your real estate purchase. So the SBA 7A has a lot more flexibility. However, the loan amount, the maximum loan amount is a bit lower, a cap at 5 mil. Now, the process for this is similar with about 45 to 90 days. The time, that's a time frame, but the terms and conditions are a little bit different. Remember, I told you about the 504 program where there's a first and a second. With the SBA 7A loan program, there isn't a first and a second. There's only a first trust deed on your property that you're buying. You can also refinance with an SBA loan if your rate is a bit high and when you got this through a hard money lender. So it's also eligible. So the terms are up to 25 years. The only difference is the rate. The rate for most SBA 7A loan are variable, and it's tied to the Wall Street Journal prime rate. Right now, the prime rate, I believe, is around 7.5. And then the bank will add a margin between 1 to 1.5% of that. So your typical rate for a 7A loan would be in the range of 9.5 to 10.5% of up to 25 years real estate. Now, a good example for a 7A loan program would be a restaurant, let's say located in Oakland, and they want to open up a second location. Now, they can do the 504, right? But they need some working capital, they need some inventories, they need to purchase some equipments for this expansion or second location. So what did they do, right? So another way of looking, instead of the 504, they can go into the 7A loan program where they can purchase the real estate as low as 10% down, then apply for a working capital for reserves, labor reserves, or rent reserves, purchase equipment, also add marketing and advertising expense to that. So altogether, they can apply in one application. So the way they compute the program is it's the total project amount multiplied by either 10 or 15%. So if, let's say, you're purchasing a real estate of $2 million and you need 500,000 in working capital, so your total project amount is $2.5 million. Now, your equity portion of that is 250. So 2.5 times 10% is 250,000. So that's your exposure. So like I said, it's 25 years. So you have a long-term amortization and your rates are decent. Okay. Let's see here. Next one would be the California State Guarantee Program. Now, this program is not so well known, in California, but this is actually a good program. This is administered by the iBank and the FDCs. I believe there are 9 FDCs. FDC stands for Financial Development Corporation. There's one here in LA. There's one in Orange County, San Diego, and throughout the state. So their sole purpose is similar to SBA. They are to guarantee or enhance. So these are not a direct program. These are what they call credit enhancers. So this is ideal for borrowers with limited collateral or newer businesses. So similar to SBA, they enhance or guarantee the loan itself, right? So they can guarantee up to 80% of the lender's loan amount. The process is about similar with SBA. However, their restrictions as far as eligibility are far more flexible. And each FDCs are in charge of maintaining their lending partners. So the lending partners are actually the ones who lend the money to the project or to the borrower. So for instance, Bank of America, Wells Fargo, what else? Some other banks out there, they can participate in this program, and then they can ask for the state to guarantee it. So what are specific examples? So for instance, if you have a salon in Fresno, right, and you get a $300,000 loan with 80% guarantee, some banks, they tend to kind of shy away from a salon business or a retail business. This is a good way for a bank to maintain their loan quotas or loan programs without sacrificing their risk tolerance. So what they will do is they will approach a financial development corporation and say, Mr. State Guarantee or Miss State Guarantee, We have a salon in Fresno. They want to get a $300,000 loan, but unfortunately, because of our credit criteria, we need to have more guarantee, or we need to have more safety into this. And then the state guarantee will then say, yes, we'll do it up to 80%. So 300 times 80%. So 240,000 would be your exposure will only be, the difference of that. We will cover $240,000. What does it mean? It means that there are about $240,000 that in case the loan defaulted, you can recover. And the exposure is minimal to a financial institution. That is why banks or financial institutions tend to apply or participate in this program so that they minimize their risk exposure. So can you imagine if it is $1 million up to 80%? So in case of a default, you can recoup 800,000 of your $1 million loan. So your only loss would be 200,000, and then 800,000 will be fully repaid. So in exchange for that, of course, the state guarantee will charge normally 2%, I think 2 or 2.5% of that. And it's paid through the financial institution. Usually the financial institution or the bank will finance that for you, and then will be part of the loan. And you can use this for similar purpose with SBA: purchase, improve, expand, and buy equipment. So similar things, all right? The next program that I'd like to talk about is the USDA BNI loan program. A lot of people are not really familiar with this program. And this is actually a good program, like I said on my initial statement. Difference being is, you have to meet some certain eligibility as far as your regional area is concerned. But if you are eligible, if you reside or you do business in that particular region, then this is the way to go, right? So the original intent of this program is to support rural businesses and job retention. Eligible areas, usually population in the rural area of 50,000 or less. The good news about this program is that instead of a 25-year real estate amortization, USDA or BNI loan can go up to 30 years. So it's like a home mortgage. USDA guarantees up to 60 to 80% of the loan. It's similar to the state guarantee program, where they will guarantee up to a certain amount. Now, surprisingly, a lot of people are asking me about this. Hey, Edgar, we are in Southern California. How in the heck are we going to qualify for a USDA loan, right? So surprisingly, there are areas in Riverside County and Imperial County. I guess Southern California is still kind of part of Imperial County, but in Riverside County alone. So if you have a business and you want to buy a building, right, and you're not really just looking for LA or Orange County, another option for you would be in the Riverside area, particularly Banning, city of Banning, or Hemet. Hemet is a nice place too. So there are areas in Southern California that are still eligible in the USDA loan program. So if an area or region is not a real of concern, this might be a good program, especially with that particular 30-year mortgage. Rates is about the same as SBA 504. Down payment is about the same as well. So it's similar. It's just a different looking at a program, basically. Now, let's go to the next ones here. What are the program requirements for each of those four discussed? So with the SBA, usually a lot of people are asking me about how can I get a property where there's a situation that there's a rental property, or some of it are rented and some of it we want to occupy. So a lot of situations have arise in this particular situation scenario. Uh, Typically, SBA will allow that. So the key that you have to remember is that the percentage that your business will occupy is must be at least 51%, and then the rest would be occupied by another tenant, or it could be multiple tenants. Now, another question that normally arises from this situation is that mixed-use property. So you have a property where there's a retail frontage building, and then on the back or on the second floor, there's a home component, usually multi-tenant, multi-family apartments or single room occupancy buildings. Those are also qualify or eligible under the program, all programs, whether it's an SBA 7A, 504, or the USDA. Now, the question that they have to ask is they measure it through the square footage. So it's as long as you have the 51% square footage of the property, meaning you're occupying the business, your business, such as 51%, then that project is eligible for any of those programs. A specific example would be a loan that I did back in a couple of years ago. It was a building in Burbank where a major recording studio wanted to purchase half of the building, and then the rest, they were occupied by multiple tenants. So the actual split was 50-50. So we had to be a little bit more creative as far as, getting it done. So what ended up happening is that the 50% is occupied, and then the appraiser considered those other areas as part of the building. So it made the program, it made the property more than half, 51%. So that's why we were able to do it. So the closet was part of the 51%. So there's a lot more ways to be creative on that. And as long as you're within the guideline, I'm sure that can be doable. Now, with the USDA, there are requirements for job creation and equity injection. So it must benefit the community. You must also create some job opportunities in your area. Similarly to a SBA 504, there's a job requirement criteria as well. Now, with the California State Guarantee Program, it is more lender qualified, meaning the qualification is based on the lender's program itself. So not all lenders are the same. Some are more risk averse, some are more flexible, some stay within those boxes. Usually my experience is that larger banks have stricter requirements as far as their credit. Regional banks or credit unions, they're a little bit more flexible, and they tend to use the California State Guarantee programs. A lot of nonprofits, or what they call CDFIs, Community Development Financial Institutions, they use the State Guarantee Program as a credit enhancer. So at least they are able to recoup or recover in case of default. Another program requirement is that all businesses must demonstrate good credit, cash flow, and business viability. So the credit portion each bank have a different guidelines as far as minimum score, cash flow requirements, or business viability. Some banks, they stay away from restaurants. Some banks, they stay away from retail stores or retail type of businesses. I know most banks love manufacturing, wholesale business, or service healthcare businesses. They consider that as least risky. However, there are banks out there or financial institutions, CDFIs, that are taking restaurants, retail businesses as their borrowers. So you just have to look for the right kind of program. An example for an SBA requires 60% occupancy for new construction. This is on top of, remember we discussed about the 51%. If you're doing a construction program, it has to be 60% occupied, or you will occupy 60% if it's a new construction. Now, qualifications. Usually you must be a US citizen or a permanent resident, especially now. I've heard with SBA, they are really narrowing down or zeroing in on documentation with regards to being a citizen, proving yourself as a citizen or a permanent resident. Experience in business and industry, they also would require the common 10% or more equity injection. Clean financial records and strong credit is also suggested as a minimum qualifier. However, like I mentioned to you, it all depends on the bank. My experience over the years is that different banks have different criteria. I've seen people get turned down by a certain bank, and then they go next door, and voila, they got approved. So it's just a different appetite for each banks. But for the most part, like I said, the bigger banks, and I'm sure most of you are banking with those big three banks or maybe big four banks out there, and most of the time they serve the traditional businesses with less risk. So it's good to bank with them as far as convenience. They have more offices or branches. You can easily get into them. However, when it comes to the smaller size banks or financial institutions, they're also a good way to do business because they can serve to your needs, especially with smaller businesses. That's the bread and butter of regional or community banks, is to serve those smaller businesses. And I think our audience today is part of that small business community. So, you may want to consider, if you're shopping around for a business loan or a commercial real estate loan, to always include a credit union or a smaller bank with your quest. Don't go with your bank first, because typically, especially if you're starting a new business, they would say no. On the other hand, if you look first with those other alternatives, usually, you can get it done quickly as well. All right. Now, I want to talk to you about the owner versus non-owner use. And we've touched base on this in the previous slide. So SBA, USDA requires 51% occupancy. Leasing up to 49% is allowed. Non-owner user must go conventional. So we talked about the mixed-use properties that's eligible. However, if you have a building where it's occupied by at least 75 or 80% by tenants, then that's a different type of loans. That's a topic of discussion at a later date. And the underwriting process for those is somewhat different. The rates are different. Down payments are different. So just think of owner user as 51%, and then you can only allow up to 49% of lease space to other tenants. A specific example for this would be a CPA firm buying a 5,000 square feet building, and then they occupy 3,000 square feet of office space. That's eligible, and then they lease 2,000, still qualifies. In cases where the USDA, the rural dental clinics, in case you know business or you're planning on moving in that particular area, the best program out there would be a USDA or a business and industry loan to buy a building or retain your staff. Now, what are the summaries and takeaways about this is that SBA and USDA affords ownership. You can put 10% down, minimal down payment. There's a guarantee involved, so it allows the lender or whoever's giving the money away to take additional risk, especially with the California state guarantee. The owner occupancy, when you are considering to purchase a building with some tenants involved, make sure to do your homework. There's, just remember 51% and 49% of tenants. Partner with experts and lenders. Like I said, not necessarily the major banks have the best program, although they do have the best programs when it comes to interest rates. When you go to your bank, especially if you bank with the major banks, they will offer you a much, much better rate. But the question that you need to ask yourself is that, yes, they offer this rate. Can I qualify to get this rate? You know what I mean? So there's a difference there between applying with a major bank and a secondary or community bank. So just know who you're partnering with. Some of the lenders out there are, mostly experienced when it comes to commercial real estate financing. And also, I forgot to mention that when you purchase or you're thinking about real estate financing, in banking area, there are different specialty or specializations out there. So make sure you're partnering with the right banker. So typically a SBA lender would be good with real estate. Conventional loans usually are being handled by, the branch managers or business relationship managers. Just do your homework as far as partnering with them. Obviously, as a summary on this, there's a lot of benefits for owning a property than renting. So there's, you can write off the interest. It increases your assets over time. A good example to this would be back in 2009, 2010, a laboratory up in Santa Clarita Valley purchased a property for about $450,000. This was, I don't know if you remember, back in those days, we were just recovering from the major Great Recession that we had, and hopefully we don't experience that again. However, back in the day, back in 2010, that lab purchased a real estate property in Santa Clarita for $450,000. So the only down payment he had was $45,000 plus closing cost. So, and he had that in his savings account. So $45,000 is all he put down on the property. And about 6 months ago, I refinanced that property. And the value of that property is now over $1.8 million. So in a span of 15 years, that $45,000 down payment has increased value, considering the smaller down, and now it's worth 1.8 million. So, that's a big benefit, advantage to owning a property as opposed to just leasing a space. Another thing that a lot of people asking me about is 100% financing, because they all hear about 100% financing from their bankers, from their real estate brokers. And is it true? Yes, it is. There are ways and there are lenders out there that you can get 100% financing. The caveat here, very important to know, is that if you're buying a specific type of property, it is very doable to get 100% of financing. When I say specific type of property, lenders out there like to have a owner user wherein it's a building that is not of a special use. So a building that's like an industrial building or a warehouse building is usually eligible for 100% financing. A building that's owned by a medical doctor or somewhere in the healthcare field is also eligible with 100% financing. Now, one way of doing this is that when they underwrite the deal, they will look at the borrower's strength as opposed to other requirements that they have. So if you're a doctor and you want to buy a medical office building, it is possible to buy it, especially if you have a strong net worth, if you have the liquidity, if you have the good credit, if you have the cash flow. So if you have those options, there are banks out there that can provide you with 100% financing. And the terms are similar to if you were putting a 10% down with SBA or USDA or 504 program. The only difference is that it only caters to a certain types of borrower that you have to fit within their box. If you don't, then you have to be a little bit more creative as far as getting 100% financing. With regards to SBA loans, I haven't seen 100% financing, but I've seen creative deals where if the borrower doesn't have the 10% down, they can ask the seller to carry at least 5%, and then the remaining funds can be the borrower's funds. So the only funds that you have to put as far as down payment goes is only 5%, and then the rest would be carried by seller financing. So with SBA, it's allowed to have a seller carryback, meaning if the seller, if you're selling your building, I'm selling my building and you're buying it from me, I would be carrying a small portion as a subordinated lender, meaning I will always yield to the primary lender in case of default. But it is possible. I've seen it happen. Not so many cases, but if you have not so great credit, you have limited funds as far as down payment, then the 100% financing option may not be available to you. However, if you have good credit, you have good liquidity, then you're in the right, if you have the right business, then yes, you are eligible, and you can probably get 100% financing. As far as the using your equity from existing property, you can do so if you own a real estate property and you want to use that equity as far as your down payment. You are allowed to do so, especially with SBA. I'm doing one right now where a home in Dallas, they're going to convert into a retirement or a residential care facility for the elderly. So they don't have much down payment. However, they do have a big equity on their credit. So one of the credit conditions is that they must put the proceeds from their home equity line of credit as part of the down payment. So it's not a home equity loan. So there's a big difference. A home equity, or a HELOC, as they say, is a line of credit secured by your home, as opposed to a home loan, which is a term loan secured by your home loan. So with SBA, it's eligible if you have a HELOC or a home equity line of credit to be used as part of your down payment. So technically, you're not using your reserves or your money for the down payment. You're using your equity through your HELOC or home equity. So it qualifies for 100% financing. And final tips and resources. Let's see here. So like I said, use experienced SBA lenders and advisors. Build a strong support team, broker, CPA, SBDC, and organizations such as PACE to help you with that. There are, before buying, do your homework, reach out to those folks, get their feedbacks, and assemble a strong team before you actually make an offer. Because most of the time, if you're just starting, to build your team, as you progress, as you make an offer, usually there might be some delays as far as, documentations and the process itself. So there's extensions and there's opportunity that may be lost if you don't close on time, right? So pre-qualify early, check maps and guidelines by reaching out to those brokers and CPAs and SBDCs. Check maps if you're considering USDA. If you go into the USDA website, I don't know if it's still working now, but the last time I checked, there's a property eligibility tool that you can use to check if the property you're interested in will be eligible under the USDA. And there are, like I said, support. There are free support from PACE, SBDC, SCORE, or GoBiz. And with that, I'm ready for some Q&A. Thank you for your time. And hopefully, this small time that we shared, I was able to impart some of the things that I'd like to share as far as commercial real estate buying is concerned. So I will be open for any questions that you have.
There is a question in Q&A box
Okay. Let's see.
and some chat box too.
Questions. All right. Okay, so I'm gonna go through, let's see. So there's a question, what would be the ideal loan for buying an existing business around $6 million? If there's no real estate involved, then an SBA 7A loan would be perfect for this scenario. However, you just gotta make sure that you're within the $5 million range guideline. So you have to put in, at least a little bit more to qualify. Now, the only caveat that I can say on this one is that if you're buying a business itself with no real estate involved, the term given by SBA would be up to 10 years. So your monthly payments would be a little bit higher, as opposed to if you have a real estate component into the loan, then your amortization would be at least 25 years. But if the cash flow is there, then I don't see why you can't qualify. And like I said, either 7A, or if that particular business is in a rural area or designated rural area, then you can use USDA as well. Then let's see here. I
Do
have
you,
a,
yeah,
go ahead.
do you have access to Q&A box? Bottom?
Yes.
No.
Yes, I have. Can you still, this is a question, so can you still be eligible for a 7A or 7A or 504 if you are doing a 1031 exchange? And the answer is yes. That's an eligible question or eligible program under the 504 and 7A. I think there's only two questions here.
And also, the chat box, there are some question in the chat box.
Yes, yeah. So checkbox would be, let's see here. Okay, I have a land that's paid in full, just need to borrow to rezone and construct. Project mixed use, I would like to do this ASAP. Yes, this is eligible depending on the business, but if two immediate things that I can think of right now is SB 504 or a 7A, depending on the how large the project amount is. And if you need some working capital and to buy some equipments, then obviously the excuse me, the 7A program would be ideal for you. However, if it's just real estate that you need to develop and construct, 504 would be the best, especially because of the rates. You will have a better rate than the 7A. What would be the best to start a mixed-use project on a land paid in full? Which program would be the best? Similarly, uh, if there's a working capital component or equipment purchases. When I say equipment purchases, these are not equipments or furnitures and fixtures that are attached to the property. So those are 7A best, 504 for just real estate because of the aforementioned rate in terms of benefits.
Edgar, would you show your contact so people, if they have questions and inquiry, they can contact you right
Yeah, yeah, sure.
directly? Somehow, screen is just freezing right now.
I'm trying to share my contact information. I guess
Um,
I can,
can you provide your material today so
yes,
I can send it the PDF file
right,
to the attendees so
yes.
that case they can see your contact.
Okay. Also, there's a question here. Where can we apply contact or you go to the LACT website for the application? Well, it depends on the bank. It depends on the program. If, like I mentioned earlier, it's best to assemble a team of brokers, advisors, bankers before you dive into the program itself. If you're buying a building, I would suggest to reach out to any of those mentioned resources such as SBDC, PACE, GoBiz to get an idea, but reach out to them, your bank. If you are banking with a major bank, you can also do so with that, but contact a credit union or a regional bank. Ask for either an SBA development officer or SBA loan officer, and they can help you with that.